Hello, I'm Phil Dobbie, and welcome once again to the Debunking Economics podcast with Steve Keen. And today we're looking at rate rises. Do we need them? Finance speculators spend an inordinate amount of time predicting how and when the US Federal Reserve, or the Fed as they're known, will change interest rates. They've already lifted rates once this year, and the predictions that they're going to do it 2 more times before the year's out, possibly as soon as June for the next one. The reason given is always to keep the economy under control, to stop it from overheating, to prevent rampant inflation, which supposedly is nudging the 2% mark right now, the rate that the Federal Reserve and most central banks around the world seems to think is about right. So Steve Keen is with us. Why does the world take so much interest in US interest rates? Is it to a country like Australia or the UK what the Federal Reserve decides to do with US interest rates?
Well, you have to actually look at 2 reasons. There's the practical reason and the mythical reason. And the practical reason is that if you have big interest rate differentials between countries, and particularly when those rates are extremely low as they are now, then people in the low-rate countries are going to be looking to put their money into speculative objects in the high-rate country and make a double whammy gain, because first of all, they get a high rate and they get back at home. And secondly, they also expect currency appreciation, largely because they're buying their currency.
Right.
So it's one of these self-fulfilling prophecies. And it's actually got a little nickname. It's called the Mrs. Watanabe effect. I might have my pronunciation wrong, but you have a Japanese housewife trying to invest the family finances, normally the wives of dentists, it appears, or dentists themselves, and they pour money into buying Australian bonds when they're more expensive, when they give a higher yield rather than Japanese. They used to do it for American when the Japanese rate was below the American rate. So that's the practical reason.
Right.
There's also a mythical reason, and that's that economists think interest rate controls the economy. We'll get to that one in a while.
All right. Well, one of those people who perhaps thinks that is Donald Trump, because first of all, he lambasted the Fed for not raising rates fast enough before the election. Now he wants low rates. So which one is right? I would have thought presumably he'd want the rates to be low, because he doesn't want that situation you described. If interest rates rise, then that's going to push up the value of the US dollar, because there's going to be more demand for the US dollar. That is going to make it much more difficult for him to export stuff effectively, which is, he wants to try and regenerate the economy. It's going to be harder for him to do that if exports are more expensive.
Yeah, well, that's the practical and that's the effective reasons why it matters as well. And this is one of the problems right now, that we have economists varying interest rates, expecting they're going to have impacts on economic activity, and what they really have impact on more than that is relative exchange rate levels. So it would undermine Donald's ambition to have an export-led American recovery if the American dollar got more expensive.
So why wouldn't everyone just say, well, no, let's keep the rates low? If you're a country that wants to try and raise your export levels, why wouldn't you just say, yes, let's keep interest rates low? Well,
this is actually Keynes's argument. He argued the real rate of interest, the base rate should be as close to zero as possible. He was in favour of very low rates, and part of the logic was that it's basically just a way of getting profit for the financial sector. It doesn't actually do much to boost investment, as the mainstream argues, but he said keeps the cost for the financial sector low and provide more of the money for the real sector that actually does the manufacturing, that borrows the money from the finance sector to enable the investment to take place. But then, if the interest rates are low, pays less back to the financial sector and has more available for actual investment. It's a bit like, in that sense, Ricardo's arguments a couple of centuries ago, which people interpreted as being in favour of free trade and things of that nature. He was actually trying to get as much money in the hands of the capitalists and as little as possible in the hands of the rentiers to enable growth to go on for longer. So a similar sort of argument goes there, and a lot of non-orthodox economists argue that the base rate should be zero.
Right, or something, but fixed. I mean, what if I know this is a flight of fancy, and I'm living in La La Land a bit on this. But if there was an agreement to just fix interest rates everywhere around the world, what would that do?
Well, in fact, intriguing, there's an excellent book on statistics called Data Reduction by a guy called Ehrenberg, one of the great practical appliers of statistics. And of all things, in his book, which is written back in the late 1960s, Data Reduction, he argued he used the interest rate as an example of a constant.
Right.
So the massively varying interest rates only started to happen when we first of all had a dramatic increase in the rate of inflation after the 50s and 60s, when the rate of inflation was down at about the 2% level, as it's taken to be right now. And then it rose to 17%. And in an attempt to control the interest rates, the Volcker can control the Federal Reserve, when Volcker was the Fed chairman, put rates up to 17%. Now, the idea was that by making, and this was, again, where myth comes in rather than reality, the idea was that would cause the level of investment to rapidly drop, basically get the price level to reset, because economic theory, the neoclassical mainstream economic theory, says that changes in monetary variables only affect nominal factors, i.e. the price level. They don't affect real factors, which simply reflect people's expectations of long-run returns. And the idea was the economy would rapidly drop the inflation rate in response to the higher interest rate, and then you go back to equilibrium again. Well, that was the equilibrium they experienced was the 90s recession or the recessions in the 80s and the 90s that led to political change. The recessions were so severe. So the practical impact of high rates is to stop people borrowing money in the first place. And by doing that, you eliminate credit demand in the economy, and the economy tanks. So that's the practical reason why this stuff matters. And that's what I think the Federal Reserve is going to find the hard way when they start putting up rates in the belief they're simply going to control the rate of inflation, because they have this belief in what they call the natural rate of interest, as well as what they see as a natural rate of inflation. And that's the real driving force behind all the stuff. There's a set of numbers, the 2, 3, 4s, and the 2% is the rate of inflation they think that should apply overall. 3% is the rate of economic growth that they think should apply, and 4% is the target rate of interest. Right.
So they put the interest rate up too high, and then people's spending decreases.
Yeah, but they think it's just an adjustment thing. This is again why they always get surprised by the real world. And this is what the Japanese central bank has been going through for 25 years now. Every time they think that the economy is adjusting and they see the inflation rate start to tick up, they then put the interest rate up in the belief this is going to do a little of a mild adjustment, so that the belief is that if they get the natural rate, if they set their rate, what they call the natural rate of interest, then there'll be neither inflation nor deflation. And in fact, their target is 2%, so then they'll get and stick at a 2% rate of inflation. Instead, what happens, if you put up those costs, when the level of debt is as high as it is right now, which is, they consider the flow of new money. They do not consider the outstanding stock of debt, because to their economic model, that doesn't matter at all. Yeah. But because the outstanding stock of debt is so high, when they put that rate up, that is cut substantially into people's headroom, whether that's individuals and households or corporations making investment plans. And they therefore decide not to borrow, because they don't borrow, they don't create credit, and the economy tanks again. And then you go through the same old rinse and repeat process. They drop rates in response to an economy that is unexpectedly declining. The economy then goes back into leveraging up again, and bang, we go back and repeat the same bloody process.
All right. Now, you described at the beginning a situation where, I said, why does it matter what happens in America? And, part of the argument was, because money will move to America if the interest rate is higher in America than it is in other parts of the world. So doesn't that mean then that if America was to, substantially move its interest rates over the next year or two, other countries like Australia, the UK, Europe would have to follow, wouldn't they? Otherwise, they'll have this big outflow of capital.
Yeah, well, that's the dilemma, and that's why America matters for the rest of the world. It's all these currency adjustments. I think But by the way, for listeners, this is being recorded on my phone, because we've had 3 attempts to get the internet working, and one of the very first investments I'm doing, courtesy of my Patreon patrons and funding, is today I'm going to buy a cable internet system so Phil and I don't have these bloody hassles in recording our podcast anymore.
That would be good.
Where was I?
Back to the question. I said we were. I knew you had to get that out.
I'm so fucking young. Pardon my French people, but I'm an Australian after all.
say the F word. That is
angry at this.
That is nothing compared to what I
heard
heard before we started recording this, let me tell you.
So
look, my point was, doesn't everybody have to respond if America responds? And I guess the follow-on to I think you're saying, yes, it does. So the follow-on is what happens if that economy can't afford it? If you push interest rates up in a country like Australia, which we're going to talk about next time, which is highly leveraged, and an increase in interest rates could have quite catastrophic effects because of so much housing debt.
Yeah, but this is the overall problem, because the rate set by the Federal Reserve is not the rate, of course, that's charged by private banks. It's the rate that the banks themselves charge each other. If they borrow reserves from each other, they have a need to do so. And that's the normal situation. So the way these rates work is that if you bank at Barclays and I bank at Lloyd's and you buy something off me, then there's a transfer from Barclays to Lloyd's of reserves exactly equal to the transaction you and I do. And as it happens that one of those, the domain doesn't matter. They said Barclays is the one that gets the money sent from it. Then it might have no reserves, and it goes to negative reserves. It has 30 to 90 days, depending upon the national situation and national regulations, to get those reserves back up above zero again. And the easiest way to do that is to borrow back the money that it's transferred when the transaction you and I caused to happen hit those two banks. So they're borrowing money from each other all the time, and the rate they'll borrow at is the rate set by the Federal Reserve. Now, if you find if a bank can't actually manage to borrow money off other banks in the system, and that can be because over the long term the level of required reserves now exceeds the amount that's in the system, they can borrow those directly from the Fed or from the relevant central bank at what they call the discount rate, and that's the rate set by federal FOMC meetings in America and so on. If that rate goes up, that's what they see as their base cost of funds, and their markup will be, for the retail investors, they'll charge that plus their cost of funds plus their profit margin. So movements in that reserve rate, if you live in a country with flexible loan rates, particularly mortgage interest rates these days, America is not one of those countries, but Australia is, then your rate will go up. So it'll be people, LIBOR rates are affected by it and so on. So all these things affect the cost of finance. And the reason it has so much more of an impact now than it had 30 or 40 years ago is because the aggregate level of private debt being carried globally is 4 times what it was back in the 50s and 60s. And therefore these movements, they're now talking about the 0.25% rate movements, but they used to talk in 1%.
Yeah, well, there's an interesting survey from the University of Michigan recently that showed what percentage of consumers say business conditions are favourably or unfavourable because of government decisions or because of elections. And I think included in that, they're talking about government decisions, including Federal Reserve decisions. Those saying that government decisions impacted unfavourably. Look, during the 80s and 90s and the first part of this century, it was normally around 5%, but from 2010, it's skyrocketed. It's often 20, 25, sometimes 30% who think that these decisions are having an influence on the economy. So it seems like, 30 years ago, as you're saying, perhaps not much influence from the government, but something has changed, and that change you're saying is because, yes, we are carrying so much debt, so even a minor movement in interest rates impacts everybody.
Yeah, and that's the danger now. That's why the Reserve moves in small increments, but it's also why, what's the old saying about those who don't study history are condemned to repeat it? One of my favourite cartoons has a story and said those who do study history are condemned to watch others repeat it. And that's been my situation since I did my work on Minsky way back in the beginning in the late 80s, to watch this happen as the levels of private debt rose, which I knew the mainstream economists were ignoring. Even though it had an impact on their decisions because they could no longer put rates up by the 1% rates they used to do. But as they've let that level of private debt rise, which they think doesn't matter economically, of course, because it does, that therefore means their decisions have much more impact upon everyday life, because now we're carrying 4 to 6 times the burden of debt we used to carry, and therefore changes in that cost of finance don't affect their decisions to invest in a direct sense. They don't have bugger all impact on how much you value a future investment, but they do affect your capacity to service your current debt, and therefore you'll stop taking out credit and the economy tanks.
Now, I know you're saying that the conventional economists don't accept that the debt has any influence. Yet we are starting to see, aren't we? From minutes from those RBA meetings in the US and the Federal Reserve minutes in the US, but also RBA, the Reserve Bank of Australia, minutes from their meetings. They are indicating that they are pontificating over the impact of interest rate rises on household debt. In fact, I think the RBA is getting very concerned about it. So there's an acknowledgement now that maybe debt is an issue here.
Yeah, but they don't understand why. And this is what's so bloody annoying from my point of view, because, one of my favourite statements by a Reserve Bank governor was by the previous governor of the Australian RBA, Glenn Stevens, giving a speech in Sydney, I think in 2009, saying, "I know of no one who warned of this set of circumstances." And I thought, I wrote a blog post about that in my debt deflation blog saying, "Know of no one." I'd been like a bout of measles over the Australian media, as you know, saying all this stuff was going to happen. I wasn't completely alone, but certainly I was the loudest. And then when he got to the Parliament to excuse his statement, somebody challenged him on that very basis, and he said, "Well, I don't know anybody who predicted, that Lohmann's would fail on this date, and so would go on that date." And I thought, what a specious bloody answer, because frankly, the only reason you could actually justify an answer like that would be if your own models had the capability, and they don't even have finance inside them. So it was an outrageous diversion. But the reality is, when you read the literature, and of course I have read the minutes of the FOMC, and which is about the only central bank that does publish their deliberations, they clearly haven't got a clue. They're worried about the scale because it's so big, but they don't know why the fact that it's so big matters. And what they look at is thinking that people are going to not be able to service the debt, and they then say, well, in fact, it's held by the rich households, and they've got the money capacity, etc., etc. They never consider the role of that change in debt in adding to demand, because according to their theories, it doesn't. Yeah. Therefore, they miss out on the major impact of it. They don't see that if that demand for borrowed money ceases, then a large part of expenditure, net gross expenditure in the economy, disappears and the economy tanks. And that's why I get so fed up watching this stuff, because it's like watching somebody who thinks that icebergs are all below hull level.
Right. So what their level of thinking probably is just the extent that there will be some people defaulting on their loans, and so
that's right.
And that's as far as it'll go.
Yeah. And but the deliberations always come down to, can they afford it? And is that the only question? It's looking like they might not be able to afford it. That's the problem. The real problem is they'll stop borrowing the money in the first place, and a substantial part of demand will disappear virtually overnight. And when it does, you'll be forced to reverse direction on interest rates again, which, if you check the data in Japan, is what they've been doing for 15 years. 25 if you go right back to when the crisis began back in 1990. So it's incredibly frustrating for me to watch all this stuff.
Now, one influence of whether the Fed is going to raise rates or not this year and next is going to depend on how much Donald Trump's government pumps into the economy with his fiscal stimulus program. Probably not much, as we've talked about. It's probably not going to happen. But if he did, then the talk is, he's pumping all this money in. That's going to be inflationary. Therefore, the Fed raises rates. So don't we have the government then and the Fed counteracting each other? Aren't they sort of working at loggerheads to try and achieve completely polar outcomes?
They are, and that's what's going to be fun to watch. I mean, there's never been a president like Donald Trump. That's an obvious statement. But his capacity to bluster and intimidate and can directly confront, rather than doing polite channel stuff, which is the standard thing for a president when this sort of clash occurs, there will be outright confrontation. He also apparently has a capability, I've got to check this up, I've just seen this mentioned recently, some capability to affect the appointment of Federal Reserve governors and therefore members of the FOMC.
Yeah.
So it could come down to fairly substantial direct political impact, putting his own cronies, and obviously I'm not using that word, it's not an exaggeration to call the people he appoints that, put them into the board. And And that itself would be an intriguing experience, because though they might be his cronies, at least they run real businesses, and they're going to get a shock when they find the sort of advice that is being put forward by the so-called professional economists in places like the Federal Reserve.
Yeah. Well, no, he does have that ability, and I think Janet Yellen's, due for replacement in about a year. Replacement, make it sound like sort of an old piece of machinery. Yeah. Well, I mean, he's basically been saying, well, he quite likes her at the moment, so he's evaluating her, so he's, making it very clear that the decision is his. But just talking about Janet Yellen, who's the governor of the Federal Reserve, what would you do right now if you were her? If you were, heading up the Fed in the US, what would your decision be?
Well, again, my approach would be the whole modern debt jubilee, which is the last thing Yellen's going to have the guts to do.
For sure.
Or their power, because to make that direct transfer into bank accounts, you really have to do a link with the Treasury at the same time. So that's what I'd be doing. I mean, the worry that the American economy has is that it's now got an accumulated private debt level in terms of non-financial sector, so that's households plus non-financial businesses, of 1.5 times GDP. It's growing at about the level of credit, which is the rate of change of private debt, is about 7% of GDP right now. That's growing faster than the physical economy by some substantial margin, and that's what's dragging the economy up. Now, the reason she's going to fall into a trap of doing the wrong thing and putting rates up to think she's going to be fine-tuning the economy is that their little model, what they call the DSGE, Dynamic Stochastic General Equilibrium models that guide their economists and tell them what's going to be the impact of any of their policy changes, has these magic numbers seared into them: 2% rate of inflation, 3% rate of economic growth, 4% target rate. That's what they think is the natural rate of interest. So they're going to move in that direction. That's where the pressure is really coming from. It's not so much from the business signals as the fact that the economy is moving roughly in that direction, but then we've got to get back to this 2, 3, 4 set of numbers.
Yeah.
So
got to reach
real danger.
Got to reach equilibrium. I've got to ensure equilibrium exists. Is basically
So this is the funny thing. It's a Deus ex machina assuring market equilibrium. The inability of these people to develop a sense of irony is really quite remarkable.
Yeah, that is. I mean, there's an irony there, isn't it? Because the economy is supposed to find equilibrium by itself, and yet we've got the Federal Reserve having to do it for
it.
What
are you buggers doing here? Yeah.
What do we need you at all? Well, that's an interesting question. I won't ask that one though. But let's go back to the question I did ask, which you sort of half answered, in that you said yes. If you were Janet Yellen, you have the debt jubilee. Let's imagine that actually takes a little while to work on. That you can't do that in your first day in the job, and there's the Fed Reserve's meeting, and they've got to make a decision. Are they going to raise interest rates in June, for example? What would you be doing? Would you be saying yes, let's go for it, or no, let's what for the next 12 months? What is the future for America and the world? Are we better off with a low interest rate future?
We'd be better off with a low interest rate. The trouble is, I mean, they've really got themselves caught in a number of Faustian bargains here. And one of the most important we haven't discussed today is the other policy the Fed's been following, the quantitative easing, because that's maintaining consistent pressure upon share prices in particular, and then also property prices, and causing bubbles in both of those markets that are now becoming really off the scale levels of overvaluation, particularly the share market in America. Now, the trouble is, if they cut that QE program out, then the market will fall. And, of course, the major political limitation on her behaviour is really not the economy, it's what happened to the stock market. The stock market starts going down. All the financial people, which are really the only industry people they talk to, are going to be screaming about the losses they're making, and they'll go back in reverse and go back into QE again. So in that sense, what you're asking me is, would I change places with Faust? The answer is no.
Right, okay. Look, if you want to know more about QE, go back to episode 26, by the way, when we did discuss that. Okay, look, next time we're going to talk about the situation in Australia. I'm sure we'll talk about Canada as well, because it's a similar situation there. But I just want to finish on this point then. If we do see the Reserve Bank, the Federal Reserve in the US lifting interest rates, what does that mean for the Australian economy and the Canadian economy? Because presumably Australia would need to react, wouldn't it?
In fact, what it does is it takes a bit of pressure off them, because for the last 6 years, the Australia's Reserve Bank has been praying that the Federal Reserve would put rates back up again, because that would have taken pressure off the exchange rate. And of course, the exchange rate when Australia had the mining boom at the same time was hitting $1.20 virtually US for each Australian dollar. And that was crueling the manufacturing sector. Now, the damage has already been done there. But if the Federal Reserve puts up rates and you're in a country which has a higher rate of interest, then it takes the arbitrage pressure off you. No. Of course, most of the rest of the world, we're talking obviously the UK, clearly Europe, Japan as well, that'll go in the opposite direction. So if the Federal Reserve rates go up, they can expect the American dollar to increase in value, which will reduce their currency costs, of course, and therefore mean they're more competitive exporting into the American economy. So they'll be quite happy about it, but of course that's going to make Donald scream again because, bang, the currency manipulators.
Yeah, of course.
Welcome to government. Yep, we're sticking at bargains with the devil. Welcome to government, Donald.
Well, maybe you're the cause of the currency manipulation, Donald. Maybe that's the real issue. All right. Well, we shall leave it there. We'll try, as I say, we'll talk about Australia and Canada next time. I think we've done 40 or so podcasts in this series, so I think next time it's only fair that we actually go back to where it all started, which is the Australian housing crisis, because it's been going on for so long. So let's get back to basics next time. Good to talk.
Okay, mate. Bye.
And we'll try and get that one out to you later on this week. That's it for the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Thanks for listening. See you next time.